Okay, so now I'd like to bring in Jennifer Mernagh of Aberdeen Diversified Income and Growth as this week's special guest. I think it's a really interesting time to be talking to Jennifer. If you just look at sort of, the uncertainty on our economic landscape and, as of this week and last, the uncertainty on our political landscape and just how volatile markets have been, I think it's really interesting to be looking at a vehicle like this that actually is a sort of multi-asset vehicle and is designed to provide lower volatility returns because it is getting its returns from a whole range of sources. And let's say, I think the NAV has held up pretty well this year, but hopefully Jennifer will be able to take us through some of that. Jennifer, are you there?
Hi, yes, I'm here. Thank you very much for having me.
So sort of first off, could you just sort of give us a 5-minute elevator pitch for how this works and how you do it, really?
Sure, of course. If you turn to slide 1, then you'll see some of the key points that I'd like to highlight. But essentially, what we're trying to do is to deliver a 6% total return over a 5-year rolling period. And we're aiming to do that with a low correlation to equities. And so the strategy of the fund is to invest in a diversified and resilient manner across multi-asset capability, and really using the access that we have at Aberdeen to own real assets and other private markets alongside traditional asset classes. And we feel that we're able to do that. So we have obviously a very deep breadth, a depth and breadth across the Aberdeen platform. So we're able to generate best ideas across all of these asset classes, including private markets, and able to do this in an unconstrained way. And what we're aiming to do is to provide income and growth over the long term for our shareholders. So I guess I could go into a bit more detail if we switch to the next slide, just to discuss performance as it's been. As you rightly noted, it's been a really quite reasonable performance over what's been an extremely volatile period. Now, the performance I'm showing here is since the board conducted the strategic review back in 2020. So in 2020, the board decided to make a material shift towards private markets and to decrease the risk of the portfolio in general. And that's when I became involved with my colleagues, Nalika and Nick. And as you can see, the performance since then has been resilient and steady in the face of these challenging market backdrop that we find ourselves in. And just to give a little bit of colour on that, where we've kind of really performed very well is from our exposure to infrastructure assets. So we have quite considerable exposure to infrastructure assets, but both public and private, which makes up about a quarter of the portfolio. And that's really been kind of the standout performer over the last period. And what we found is that the other investments we've got have not been too volatile, and haven't been too kind of moved about by the volatility we've seen in markets. And we can talk a bit more about that a bit later. I think that's important to highlight, that we're actually delivering what we said we would, so delivering what's on the tin, so to speak. And then if we go on to the next slide, just to say that, obviously we are facing very challenging markets at the moment. We've got high inflation, we've got sluggish growth, we've got central banks that in the developed markets, at least, that seem to have been behind the curve on this and are having to think about aggressively raising rates and beginning to do that. And so this creates quite a difficult kind of market backdrop, as I'm sure that you've been experiencing with the other investment trust managers that you've been interviewing over the weeks and months that have gone by. So what I wanted to show here with this slide was just how we positioned and what's that mean given the backdrop that we're facing. So about half of the exposure is to private markets, which are long-term holdings in nature. So you hold these assets for multiple years. And then the remainder is split between equities and fixed income and credit holdings. The equities that we hold tend to be lower volatility in nature, providing an income. And then the fixed income and credit is split between asset-backed securities, which is typically kind of, I guess, corporate and commercial real estate or residential real estate backed lending, but kind of structured so as to be more bankruptcy remote than typical credit holdings, and then emerging market debt, which I'll talk a bit more about in a little bit, just to explain how we kind of fund that, what currencies we're using to fund that, because it's local currency in nature. And then if you turn to the next slide, we've kind of put a slide together to show you what the characteristics of these investments are, because it can look quite overwhelming, I suppose, given the nature of the multi-asset portfolio that we've got, investing in many different things. So, sorry, I've now got a frog in my throat, sorry. So, yes, so what I've shown here is which investments are inflation linked in nature, which are uncorrelated, which are exposing us to growth and rebound, and then where we've got exposure to kind of floating rate in some manner. So you'll see that where we've got inflation linkage, that's predominantly coming from listed and unlisted infrastructure and from real estate. So those are kind of cash flows that are linked either implicitly or explicitly to inflation. So there's a reasonable degree of kind of direct protection from there. And then we have exposure to what we call uncorrelated income. So things like royalties, which I think you were speaking about actually just before. Yeah. So things like royalties, both in music and healthcare, some litigation finance, which we feel should be uncorrelated or less correlated to what's going on in markets, which is kind of driven by, as we discussed, central banks kind of slightly behind the curve, and inflation characteristics that we're seeing coming through and really knocking markets about. And then finally, we have kind of rates protection from floating rates. So the asset-backed securities that I was talking about, they are floating rate in nature. So as central banks are fighting inflation by raising rates, the income that we're receiving on those is floating, so it comes back to us with kind of elevated rates as those go up. And then just finally on emerging market bonds, interestingly, emerging markets have not been behind the curve when fighting inflation, have had to retain credibility, so are quite far ahead in that. And notwithstanding Russia and Ukraine, which we had a very marginal exposure to, have actually done a reasonable job in kind of maintaining credibility. So you haven't seen kind of assets flowing out of those markets. And they've been very resilient actually in the last 12 months or so. We actually fund that using a currency basket. So we do have kind of exposure, I suppose, to the floating rate kind of nature of the currency as well, but on a diversified basis. And then just finally, we have exposure to kind of rebound and growth opportunities from both listed and private equity exposures. As you can see here in the kind of turquoise. And then, so that's how we're positioned currently. I think that's a relatively, say, defensive stance. And then if we turn to the next slide, slide 5, it just gives an outline of the kind of economic scenarios that we think that we're facing, either that we're in or we're facing over the coming 24 months. So the baseline, as you can see here, the Fed kills the cycle scenario, as we've named it, contains a global recession. So basically the Federal Reserve in the United States of America will have to continue to increase rates in order to fight inflation. And this, we think, is going to bring about a recession, and probably a global recession going forward, as they have to fight inflation and other central banks have to try to do the same. And then there are other scenarios that you can see here that optically look like upside scenarios, but some of them do still themselves contain a global recession. So even with the scenarios that look better, they're kind of just less bad. So we think we continue to see quite challenging market environment going forward from here. So with the diversified multi-asset portfolio that we've got, we feel like we can offer some protection from some of those adverse outcomes. But obviously there are many risks that we'll face going forward, and we have to be very careful in the way that we're deploying capital. And then if we move on to slide 7, I can talk a bit more about kind of how we do it, what the trust offers to shareholders. And essentially I break it down into 3 categories. So we are doing research, we are providing access, and we are trying to put in place smart portfolio construction. So what we do is we start with capital market assumptions for each of the asset classes that we're interested in investing in. And obviously we've got this hurdle of 6% total returns over a 5-year period. So there are certain asset classes up until now have been excluded. So things like government bonds just haven't met the grade. So we haven't been taking exposure to that. But we look at capital market assumptions, we make our strategic asset allocation on the basis of those and the basis of what we think kind of qualitatively makes sense to be exposed to. And then in between rerunning our strategic asset allocation, we make tactical asset class asset allocation decisions. And we do all of this in conjunction with investment research teams and groups across Aberdeen's extensive platform. So we are able to tap into those investment professionals across Aberdeen's platform who are best engaged or most engaged in the asset classes that we're interested in taking a view on. And then just turning to access. So we are very privileged at Aberdeen to have access to idea generation, both in public markets, but importantly in private markets. So we have a network of colleagues that are originating private market investment opportunities for us as a day job. And we get to tap into that origination network. We essentially, kind of get to go to the front of the queue in that, which is, I think, something that's kind of not readily available everywhere or not accessible everywhere else. And then just turning to portfolio construction. So we have proprietary analytics and risk framework that allow us to understand the factor risks that we're exposed to and to understand how those assets and factors might behave in different market environments. And obviously with private market assets, there's a good degree of kind of experience that needs to be brought to bear in how these assets will behave, because they're not homogenized in the same way that some public market assets are. So we work with colleagues in our private markets teams in order to really understand those factors that we're exposed to and how they might behave.
We do actually have a question on that. I mean, somebody has asked,
yes.
How do you actually decide what level of exposure to have to each asset class?
Yes. So it's a good question, and it's a function of the constraints that we have. So where we want to only have a certain amount of exposure to private market assets or to particular so from a liquidity perspective we've got a constraint, and then from a kind of asset perspective we have constraints around asset classes and maximums, minimums that we want to employ, and then we use our capital market assumptions and our qualitative judgments in order to come up with the asset allocation that we think is appropriate for the time. So it's a combination of kind of hard quantitative modelling and a qualitative judgment that has to be made. Yeah. Combined with what we're trying to achieve, which is the 6% return target with a low correlation to equities.
There's actually an interesting question here that might sort of feed into that. So somebody sort of pointed out, I think looking at one of the donut charts a moment ago, exposure to private credit is quite low at 4.5%. So what is your strategy in private credit, and why not allocate more?
Yeah, so our strategy in private credit is to try to generate principally income from those investments. Why not more? I guess that when we put the asset allocation together, the most interesting kind of investment exposure that we've had, and we've had it for quite some time, and it's been top of our kind of list of preferences, is to infrastructure assets. So as I mentioned, we've got a quarter of our exposure to infrastructure assets. We like it because it has a nice thick kind of risk premia on top of kind of government bonds, which we think gives a good kind of return on capital and a good level of protection from rising rates. We do like private credit. We just feel that there are other opportunities that are kind of more attractive, or have been more attractive recently. It doesn't mean to say that we can't change our allocation going forward.
Yeah, yeah. I suppose one question related to that sort of come up, just talking about sort of recent volatility in markets. How has that impacted the portfolio? I guess, it's probably shown up in the equities the most, but have you sort of made any changes in relation to that?
Yeah, so I mean, we've been noting the risks that were described on that bubble chart for at least 9 months, if not longer, and responding to those increasing risks as time has gone by. So we have been, over time, kind of reducing more risky exposures, what we could deem to be risky exposures. So taking down listed equities during that period, taking down some of the what we consider to be more risky credit exposures. So some of the kind of more frontier emerging markets, some of the more junior ABS, we've been reducing exposure to. And I guess that, that is where you would expect to see the most volatility. And then, where the least amount of volatility has been coming from has been our infrastructure names. Some of our even private equity names have been, our private equity exposures have been relatively resilient. Obviously, we're going to test that going forward, and everybody's been able to read kind of headlines in newspapers about things like Klarna, for example, in the next funding round had a huge a huge markdown.
Yeah.
We are not exposed to those kinds of private equity investments. The type of private equity investments that we've got, yes, are exposed to growth, but we have a more limited exposure to those technology type investments.
Yeah.
We are looking for more kind of stable, more. So, for example, there's one investment we've got. It's to a manager called Bonaccord. They invest in private market managers, and we collect a proportion of the management fees that they charge on commissioned capital. Right. So, as you can see, that's not anything like kind of what Klarna does. It's something, it's related, but it's pretty different.
Yeah. Okay. We've actually got a sort of question on your sort of private market exposure. You said, so what are the risks associated with investing in this area, and how do you mitigate them? I mean, I'm thinking sort of more broadly, your sort of private equity exposure, but how sort of do you offset those risks and manage them?
Yeah. So there's many different ways of thinking about the risks. I guess from an investment strategy perspective, we think about what volatilities are appropriate for those asset classes. Obviously, the volatility you see in the NAVs that are produced is very low, but the reality is that these some of these investments are exposed to kind of the kind of vagaries of economics. So we do consider them, for example, with private equity, we're looking at kind of double-digit volatilities for those, kind of in the 20% range when we do our modelling. For infrastructure, we're looking in the kind of mid-teens. So when it comes to portfolio construction, we were considering the risks that we think they're presenting, rather than just the NAV risks. So we take it from that perspective. From a private markets perspective, I was coming from a kind of a more listed market background. I do think about the operational risks that come with private market investing. So there's no straight through processing. It's very hands-on, and that's why we are, that's why I feel very comfortable taking those risks, because we have colleagues who've got lots of experience investing in private markets, know how to due diligence these assets, know how to manage them through the life cycle of the investment, and a resource to do it.
Yeah.
And so
Yeah.
that, you know, that's one of the major risks that I think needs taken care of, and I think Aberdeen does a good job of doing it.
It might be worth just talking to that a little bit longer, or sort of a bit more detail, because if you look at the, say, sort of donut slide we had a couple of moments ago, this is incredibly diversified. There are just so many facets, so that must be quite tricky. One, obviously, you say to sort of manage the sort of different risk elements, but obviously you've got the systems to do that, but also to actually sort of find and then sort of manage these opportunities. I mean, can you sort of talk about the resourcing that you have around that, perhaps a bit more, give people a little bit of insight?
Yes, yeah. So in terms of kind of the resourcing for looking at the opportunities, we have a really significant platform of investment professionals whose day job is to look at specific asset classes, for example. So we are fortunate to have access to the forums where these investment opportunities or research, kind of investment strategy research, is kind of surfaced. So we're plugged into that kind of large network, but which is kind of filtered through these forums. So it does, like you say, it does, when you look at the portfolio, it does seem complex, and it is, I suppose it is complex, but we are, I think, well resourced and organized in order to properly curate the strategy and the opportunity set that's coming through.
Yeah. Okay. Let's just guess on that. We've got a question on the renewables exposure.
Yes.
So what kind of renewable investments are in the portfolio at the moment, and do they offer a degree or any degree of income protection? I imagine that's probably relating to inflation.
Got you. Okay. Yeah. So it's a reasonably diversified mix of renewables. So, you know, exposure to solar, wind. We've got some battery storage exposure and so on. And in terms of kind of inflation protection or kind of rate rise protection, we have seen, actually, interestingly, during the period where inflation has really ticked up, cash flows responding to that, those rises in inflation. So where power prices come up, some of these infrastructure investments we've got are able to, or have contracts in place where